Welcome to the deep dive. Our mission today is a high-altitude look at some pretty high-stakes strategy. You've handed us the sources from a recent Investor Day Q&A, and we are diving into, really, the core question facing modern finance. How does a massive AI lending platform build a business that is not just smart, but truly macroeconomically resilient?
This is the critical tension,
Yeah.
right? And the source material really doesn't shy away from it. On one hand, you have this platform claiming to have the fastest, most sensitive underwriting model ever. But on the other hand, their business model is evolving. They're retaining more risk, more skin in the game, especially with residual losses.
So we have accelerated risk awareness colliding head-on with accelerated risk retention. The dilemma for investors and really for you trying to understand the future of lending is right there.
Exactly. Our job today is to cut through some of the marketing language and really get to the underlying mechanics. We need to assess the actual economic sensitivity of this platform now versus how it was in past cycles. What did they actually fix technologically, and how are they structuring things now to withstand the next, big period of turbulence?
Okay, let's unpack this. I think we should start in the engine room. The AI model itself. The sources highlight this crucial technical distinction that separates their new approach from the old one. And it was a massive investment that came directly out of the market shock of early 2022. That seems to be the moment they realized things were fundamentally broken.
It all boils down to the difference between two kinds of predictive modeling: separation versus calibration. And before 2022, they were fantastic at one, but severely lacking in the other.
Okay, let's start with separation. In practical terms, for underwriting, what does that mean?
Separation is the model's ability to accurately rank the relative risk of borrowers against each other. Think of it like grading on a curve. The model is really good at knowing that borrower A is, say, 2.3 times as likely to default as borrower B. This relies on all that new granular data cash flow analysis, those behavioral data embeddings we hear about, even those wild details like, how often someone eats at Chipotle.
And the sources confirm that even during that 2022 shock, that side of the model, the ranking part, it held up great. It knew who the riskiest people in the group were.
Correct. But here's the problem. If the entire macro environment shifts, if the whole class suddenly gets worse, knowing who's best or worst in that group is kind of useless if you can't predict the overall failure rate. And that brings us to calibration.
Calibration, so that's the ability to predict the aggregate level of defaults across the whole pool.
Precisely. And pre-2022, they just hadn't invested there. So when the market shifted, their lack of calibration meant they were completely blindsided. Actual losses were 50% higher than what the model had predicted. And that 50% surprise, it wasn't just a painful financial loss. It was a failure of confidence. It cratered their ability to get funding when they needed it most. Capital markets just flee when they see that.
Okay, so here's where it gets really interesting for me, the technical fix. They solved the calibration problem by introducing time as a dynamic variable. It sounds so simple, but it's a huge shift from how you traditionally train a model where all historical data is sort of treated equally.
They essentially told the AI that one of those important facts it needs to know about any data point is the day it happened. By including the data as a feature, the model can look for what they call interaction effects.
So instead of just saying a FICO of 680 means X risk, the model can now say a FICO of 680 in Q3 of 2024 means Y risk, but that same FICO in Q1 of 2020 meant only half of Y.
That's the mechanism. It lets the model see, in aggregate, that a borrower today with the exact same characteristics might be twice as likely to default as their statistical twin from 4 years ago. It creates this mathematical memory, you could say.
And the source material gives some really specific examples of how fast this works, like with the government stimulus checks.
Absolutely. They saw that a low-income borrower was statistically safer, less likely to default back in 2021 when stimulus was flowing, and then that risk profile degraded almost immediately in 2023 after the stimulus ran out. But the key here is that the model doesn't read the news. It's not reading headlines about the economy. It's reading early delinquency data. It just sees that statistical volatility in these, seemingly arbitrary subsegments, and it instantly prices in the new risk.
And that speed is astonishing. The numbers really back it up. They claim this one innovation reduced their loss variance, that unexpected shock, from 59% down to 22% in just the first quarter of 2022 alone. That's the kind of confidence building that unlocks capital again.
Which brings us perfectly to the strategic shift. If the new model gives you this level of dynamic confidence, how does that change the business? They fixed the engine. Now, how do they redesign the car to handle the speed and, well, the added risk.
This moves us into that strategic implementation and specifically this concept they kept mentioning, the macro insurance layer.
Right. This is the philosophy that underpins their agreements with capital partners now. The core bet is on getting the aggregate performance correct over a full economic cycle. They see the loans from any given quarter, a vintage they call it, as being tied to the macro environment of that quarter.
So vintages from easy, benign periods are actually designed to overperform, to make excess profit. And vintages originated during tough times, like a recession, are expected to and designed to underperform.
Exactly. The structure of their agreements lets them harvest the overperformance during the good times to financially cover for the underperformance when things get tough. This whole balancing act, structured over longer time frames, is their macro insurance layer. It stabilizes returns and, in theory, prevents that kind of capital shock they saw in 2022.
Okay, but if they're holding on to more risk, that sounds like it needs really stable, committed capital. How do they balance that need for stability with the flexibility an AI model needs when it's changing prices and risk models every week?
That is the central investor concern, and they addressed it head-on. They were clear that 100% committed capital isn't actually ideal. They need flexibility to react to what the model is telling them. If the AI sees risk falling fast, they want the agility to price that risk down immediately to gain market share without waiting for some long renegotiation.
So committed capital is the floor, but uncommitted capital gives them the room to maneuver.
Precisely. They said they need well north of half of their capital stack to be committed, firm agreements that won't vanish in a crisis. The operational difficulty is putting scaling agreements in place that can grow with the platform. They said they feel pretty comfortable with where it is now, but they admit that keeping that high percentage as they scale is, an ongoing challenge. The goal is stability, but it has to be flexible.
All right, so we've established the engine and the chassis. Let's pivot to growth. The sources confirmed this fundamental AI model is designed to expand way beyond what they're doing now. They intend to play very broadly, starting with the home category.
The intention is definitely clear. This foundational model is seen as universally applicable. Their stated expectation is aggressive expansion into major verticals. We're talking purchase mortgages, refinance mortgages, and then eventually moving into business credit too.
And this is where we get to the core insight of this whole model, right?
Yeah.
Is the platform really claiming that mathematically underwriting a $500,000 mortgage is the same problem as underwriting a $10,000 personal loan, just with different data?
Fundamentally, yes. That is the entire premise. Mortgages, personal loans, business credit, they see it all as just different data sets that can be solved by the same underlying AI infrastructure, the one that's designed to dynamically adjust for macro forces. If they nail calibration, the product itself is almost secondary. The challenge is operational. It's about balancing that growth speed with reality.
Right, because they confirmed they still have very modest market share in their current products, even with all this enormous growth opportunity. So rolling out something as complex as mortgages is a calculated trade-off. They have to decide when to pull people off, optimizing what they have to spin up totally new teams. It's going to be a controlled expansion.
This huge confidence in their future, it stems directly from a belief that their tech is just better. Which brings us to the competition question. When investors pressed them on whether competitors were closing that AI gap, their response was, well, it was strikingly arrogant, or maybe just brutally honest.
They see no evidence that the rest of the industry is taking on these kinds of calibration problems that they solved. They even went so far as to say they feel like they are competing with ourselves. They see themselves as a category of one.
And that sounds like classic founder bravado. But what's the concrete evidence they pointed to, beyond just the tech specs? How do they prove competitors aren't just, one quarter behind them?
It comes down to their unbundled thesis and the historical posture of the banks. They believe any bank or fintech building lending as just an add-on to their main product, like a payment app or a checking account. It's not going to be viable long-term. This platform is focused on being the lending unbundled play, a trustworthy destination for you, the consumer, to shop for credit, where credit is the only thing they do.
And this highlights the major weakness of traditional finance. The sources had this anecdote about a chief risk officer from a huge U.S. bank who basically admitted they only wanted to serve about 10% of the American population. The big banks have to move slowly. They have to adopt tech conservatively. It's just their nature.
And that slow, conservative adoption creates massive confusion for you, the consumer. If you apply to 5 different banks, and they all use different static, slow models, You have no real idea what a fair rate for you should be. That lack of transparency is our entire value proposition.
That patchy, slow adoption, what they call a sparse matrix of adopters, it creates enormous value for the platform that acts as the central aggregator. If they can guarantee the experience and the rate, and then match you to the right lender in their network, everybody wins. Their fundamental bet is that the leader in this technology will get the most volume and therefore get the most data, and the cycle continues.
So let's bring this home for you. The core engine of this platform's entire strategy is that shift. From just optimizing relative risk, that separation, to mastering economic sensitivity through calibration using time as a feature. That mechanism is their insurance policy against the macro cycle.
And if we connect this back to the bigger picture, this whole discussion suggests that all traditional credit products are just different applications for the same foundational AI. They're betting that rapid dynamic risk adjustment will make mortgages and personal loans functionally identical problems to solve. You should really consider how this concept of permanently underwritten, guaranteed rates that update almost in real time based on macro data, fundamentally changes the entire lending landscape for every single major financial decision you will make over the next decade.